Welcome to This Explainer. Today, we're unpacking a massive shift in the financial world. We are talking about a concept that is literally reshaping how modern investors build and diversify their portfolios: real estate crowdfunding. So let's dive right in and explore exactly how this whole asset class actually works, the kind of returns you might expect, and, crucially, the hidden risks you absolutely need to watch out for. You know, for decades, there was this really persistent assumption that investing in institutional-grade commercial real estate, think those massive apartment complexes or towering office buildings downtown, was an exclusive VIP club, a club reserved strictly for the ultra-wealthy or massive financial institutions. So the big question is, do you still need millions of dollars just to get a seat at the table? The short answer? No way. Absolutely not. Thanks to modern crowdfunding, platforms like Fundrise actually let everyday investors get started with just a single $10 bill. It's wild, right? This approach has completely democratized an asset class that historically had incredibly high barriers to entry. But before we get too far ahead of ourselves, let's make sure we're on the same page. What exactly is real estate crowdfunding? Essentially, you are just pooling your money online with a whole crowd of other investors to fund specific properties or development projects. Instead of taking on the massive debt and, let's be real, the 3 a.m. operational headaches of buying an entire building all by yourself, you invest smaller amounts across multiple projects, and you just passively earn a share of the profits. What's really fascinating here is just how fast this industry grew up. I mean, it went from a novel tech idea to a heavily regulated financial market in almost no time. It kicked off back in 2012 when the Jobs Act in the US expanded capital raising. Then fast forward to 2015, we saw the launch of the very first electronic real estate investment trust, or E-REIT. By 2016, the floodgates totally opened up to non-accredited investors. And jumping to 2021, Europe rolled out the ECSP regulations, creating this harmonized cross-border rulebook. So yeah, this isn't just an experiment anymore. It is a legitimate, rapidly evolving global market. Okay, so let's actually trace the money. How does a typical equity-based deal flow? Well, funds move from you, the investor, right through the internet platform and into a special ad hoc company that's created specifically for that one project. That company then uses the pooled funds to acquire or renovate a property. You get paid from the tenancy contracts along the way, and eventually when the whole property is sold to a third party, the final profits flow right back down the chain to your pocket. So how does this fit into your actual strategy? Well, on these platforms, you essentially have two main choices: debt or equity. If you go with debt, you're basically acting as the bank. You get steady, predictable interest payments, but your upside, it's strictly capped. Now, if you choose equity, you're stepping in as a part owner. Sure, it's riskier, but if the value of that property absolutely skyrockets, you get to share in that massive upside windfall. This brings us to a totally crucial concept, the capital stack. This basically maps out exactly who gets paid first, which is super important if a project tanks and the property gets liquidated. Sitting pretty at the top is senior debt. It's the safest, they get paid first, which is exactly why it offers the lowest returns. Then you've got mezzanine debt, followed by preferred equity. And finally, down at the very bottom is common equity. That carries the highest risk of being completely wiped out, but it's also kind of the VIP room, offering the absolute highest potential reward if the project really thrives. Right, so once you've decided where you want to sit in that stack, a new and honestly somewhat hidden challenge pops up. When you're staring at a deal on one of these platforms, how do you actually measure your potential returns? Operators are going to throw a bunch of different numbers at you, and you really need to know how to decode them like an insider. The two heavyweights you are definitely going to run into are IRR, which is internal rate of return, and equity multiple. Now, equity multiple is beautifully simple. It's just the total cash returned divided by what you put in. Say you invest 10 grand and get 18 grand back. Your multiple is 1.8x. Easy, right? But it completely ignores time. IRR, on the other hand, gives you a percentage yield that actually accounts for when you get your money back. The catch? A savvy operator can totally manipulate IRR just by tweaking the timing of the distributions. So honestly, neither metric really gives you the full picture on its own. And to really get why IRR is such a big deal, we have to talk about the golden rule of finance, the time value of money. Simply put, a dollar in your hand today is inherently worth more than a dollar promised to you 5 years from now. Why? Because you could be investing today's dollars somewhere else to earn a yield right now. IRR is important because it factors that erosion of value directly into its percentage. So what kind of numbers are we actually talking about here? Historically, depending on your risk tolerance and whether you're sitting in debt or equity, real estate crowdfunding targets potential annual returns anywhere from 6% to 14%. That is incredibly attractive. But as we all know, return is always tethered to risk, which naturally brings us to the elephant in the room, the alternatives. I mean, if you just want hands-off real estate exposure, why not take the easy route? Why not just log into your brokerage account, click a few buttons, and buy shares in a traditional, publicly traded real estate investment trust, or a REIT? Let's stack them up side by side. The most glaring difference right out of the gate is liquidity. Public REITs are highly liquid. You can sell your shares on the open market at 10 a.m. on a random Tuesday if you want to. Crowdfunding? Not so much. Your money is basically locked in a vault, often for anywhere from 3 to 10 years, with virtually no secondary market. On the flip side, though, because REITs trade just like regular stocks, their prices are super volatile and swing with market sentiment. Crowdfunding values, however, are tied purely to the underlying property itself, which kind of shields you from that day-to-day stock market panic. So this creates a really fascinating trade-off. With crowdfunding, you're aiming for an illiquidity premium, meaning you expect higher returns as a reward for willingly locking your capital away for years. But with public REITs, you're essentially paying a liquidity premium. You are sacrificing a bit of that potential project-specific yield just for the absolute convenience of being able to cash out instantly. All right, reality check time. We need to pivot to something a bit sobering. What happens if the actual real estate project is doing perfectly fine, but the tech platform that connects you to it suddenly goes bankrupt? This is a really unique structural risk specific to crowdfunding. This quote from Smart Asset really hits the nail on the head. They note that if the platform goes out of business, your investment could be at risk and recovering your funds might be incredibly difficult. Think about that for a second. You aren't just betting on a brick-and-mortar building. You're heavily betting on the operational survival of a fintech startup. And guys, this isn't just a theoretical worry. Take the recent collapse of Krogafit, for example. They were a prominent, fully regulated crowdfunding platform over in France. They held all the correct licenses from European authorities, and yet they still went under. It sent shockwaves through the industry, proving that having a super polished website and a regulatory stamp of approval absolutely does not guarantee a platform can actually survive market shifts. There are some incredibly vital lessons here for us. We learn that these platforms sometimes scale way too fast without proper stress testing. When projects face inevitable delays, the platforms can suddenly go silent, and that lack of transparency destroys investor trust in a heartbeat. But perhaps most importantly, investors who poured all their cash into just 1 or 2 projects on a single platform faced devastating single-point failures. That is a really dangerous trap. So, how do we protect ourselves? You have to build your own defensive shield through rigorous due diligence. If you're looking at U.S. platforms, always verify them through FINRA's broker check. Actually take the time to read the SEC Form C disclosures. A great rule of thumb, make sure the project sponsor has at least 3 years of experience in that specific type of real estate. And whatever you do, don't just chase those high marketed returns without totally understanding the fee structures, because those can swing wildly from 0 all the way up to almost 5% a year, depending on the platform. Because of these very real illiquidity and platform risks, financial advisors generally suggest keeping your alternative investments, which totally includes real estate crowdfunding, to a constrained portion of your overall portfolio. Usually, the sweet spot is somewhere between 10 to 20% of your investable assets, landing comfortably around that 15% mark. The rest should stay in traditional liquid assets. Bottom line, you only want to commit money that you can genuinely afford to have locked away and inaccessible for several years. Crowdfunding has absolutely brilliant potential. It has opened the doors to institutional quality real estate, offering targeted growth and a level of transparency we really haven't seen before. But it does strip away the safety net of professional corporate boards and daily liquidity. So I want to leave you with this to consider for your own portfolio. Given your personal time horizon, are those high liquidity premiums of direct crowdfunding truly worth the platform risks? Or are you better off just paying for the convenience of a traditional REIT? Definitely something to think about. Thanks so much for joining me on this explainer, and as always, keep learning.